Well, hello and welcome here for the weekly update here for YouTube. Thank you guys so much for being here. Now, what we want to talk about is really what's going on under the surface. What are we likely to see over the next several months? What will be the best educated guess based on the data, based on the facts that are occurring right now globally, in particular the US? So we're talking about bonds. Okay, now bonds have moved down considerably in 2022, and we can have a look right here that 2022 was the worst ever year for US bonds ever. Now, typically, what you would see is as the markets move down, bonds move up. However, what we saw in 2022 was bonds down and the stock market down. So the traditional way of investing is to invest 60% of your money in stocks, 40% in bonds, and the idea is stocks go down, bonds go up. And obviously, if the markets go up, bonds go down. So they offset each other. They minimize your risk. They diversify your risk. However, that is not working. For the first time in 100 years, the traditional way of investing is broken. It does not work. And this started to happen in 2022, where the stock market had its worst start to the year in 50 years, in half a century. Its worst start. What did bonds do? They tanked. They moved down considerably. So you're getting stocks and bonds were moving down in unison, which is a really big problem, very unusual. So this big move down in bonds, which you could see here by just looking at this chart, TLT, and if we go back and we have a bit more of a look at this, we say we look at this over the last year or maybe even over the last 5 years, you can start to see the very big move down in bonds, right? Huge move down in bonds. And the stock market was moving down as well. So people like, or countries like Japan that has 1.1 trillion, that's right, trillion dollars worth of US bonds. They are sitting on incredibly large unrealized losses with bonds. If for whatever reason they have to start selling these bonds and they go from unrealized to realized, the Bank of Japan and Japan as a whole are in a lot of trouble, and so is the whole global financial system. China has hundreds and billions of dollars worth of US bonds as well. So we're getting a lot of countries that are sitting on massive unrealized losses. Now, what they can do is they can just simply sit on the bonds until they mature and they can get the money back, right? So you invest $100 in a bond, you hold it for 10 years, at the end of 10 years you get your $100 back. Plus you're getting a coupon payment for holding the bond as well. But what about if you can't hold it until it expires? What about if you can't hold it until maturity? Right? This is where the problem comes in because it goes from an unrealized loss to a realized loss, and this is where people with massive exposure to bonds are going to be in a huge amount of trouble, like Japan, like Russia, like China, like the banking system, right? And this is why we're seeing banks moving down considerably, and there is a dire warning for 200 banks in the United States that have the same problem that Silicon Valley Bank had, and the other banks that have collapsed, the same problem that they've had, where you saw bonds move down considerably. And what you started to see in 2020 and 2021 was that there was a huge amount of money that went into banks. Okay, there was a huge amount of money that went into banks. And in 2020 and 2021, this was all a result of free, easy money, quantitative easing, people getting stimulus checks, all that type of thing, and people were putting money in the bank. They were locked down, they weren't spending, savings were at record levels. So what the banks did is they put people's deposits into bonds, and then bonds had their worst year in history. So they've put a huge amount of people's money into bonds. The bonds have then dropped dramatically, worst fall in history in 2022. And now the banks are sitting on massive unrealized losses, and several of them have already collapsed, with another 200 banks in the United States in the same position with massive unrealized losses because of the fall in bonds. So this is a really big issue. Now, what they can do, like we spoke about, is simply hold on to their bonds until maturity and they get their money back. But what about if people start taking their money out of the banks like they are doing right now, putting them into money market funds, into the money markets, right? So what does that mean, money markets? People say that, but what does it actually mean? It means they're taking their money out of the banks where they're getting about 0.5% interest and putting them into, say, CDs, certificates of deposit, where you have to lock your money away for, say, 6 months, a year, or whatever the time frame is, and you can get up to 4.5 to 5%. In the bank, you're getting 0.5%. You can take it out of the bank and put it into CDs, certificates of deposit, and get 4.5 to 5% returns. So what you're seeing now is that people are taking their money out of the banks and putting them into the money markets. So what the banks are now forced to do is to sell the bonds, which have huge losses, to give people their money back. Because remember, it's a fractional reserve banking system, which means they only have a small amount of deposits to cover the amount of money that they lend out. So when people start taking a lot of money out of the bank to put it into certificates of deposit, for example, to get higher returns, this causes the banks to have to sell bonds, and right now bonds are at a massive loss on their balance sheet. So this has a cascading effect, and this is a really big issue. So the Fed sees this. The Fed knows that this is coming, and they know that while they did raise rates again just recently, another 0.25%, the official cash rate sitting there around 5%, this is going to be something that they're going to have to pause at some point, right? So over the next couple of months, you're going to see a shift in the Federal Reserve, I believe. That's my best educated guess. No one knows, right? No one knows. But what we have to now look at is the numbers, the facts. Look at people's actions, what's happening around the world, and this is what we're seeing right now. So my best educated guess is that now that we have banks with massive unrealized losses, huge unrealized losses, right? US banks have around $620 billion of unrealized losses on their balance sheet. We've got countries with trillions of dollars of exposure to bonds, right? So there is a huge problem here. And if the Federal Reserve, like they've done, taken rates from virtually 0 to 5% so rapidly, 10 interest rate rises in a row, you're eventually going to see cracks in the system. And where are the cracks showing up? In the banking system for now. But it can get a whole lot worse than this if the Federal Reserve doesn't change course. Now, obviously, they're continuing to raise rates because they're trying to bring down inflation. Inflation is their number one key here. But do you want to crash the global financial system, or would you rather keep inflation under control? Well, I think they're going to be very much looking at protecting the global financial system rather than being stubborn about trying to keep inflation down. So there's going to become a risk to reward scenario, a trade-off here at some point where the Federal Reserve will need to at least pause raising rates, right? What I believe will happen from there is we'll probably get a large move higher in the markets. That's normally what you would see. Now, the NASDAQ has had a very nice move up just recently. In fact, this is the best quarter for the NASDAQ since 2000, right? So it's a pretty big deal, right? The first quarter of the year, the best quarter in the last 23 years. Okay, so we're already starting to see this move as the markets are starting to sniff out this possibility of the Fed pausing or even reducing rates because of the reasons I just mentioned. This could open the door to risk assets that are very much located within the NASDAQ, because the NASDAQ obviously has technology-based companies, and that would then open the door to things like Bitcoin as well, and other risk on assets. Okay, so this is going to be something to keep an eye on. So that's where we're situated right now. Now, as far as news that comes out this week, we have a lot of manufacturing data that could impact the market, along with employment, right? We've got the JOLTS job openings, we've got the non-farm payroll, and we've obviously got our hourly earnings. We've got the unemployment rate as well. So a lot of manufacturing and employment reports and data coming out this week. If the labor market is still very strong, the Fed, that really gives them the door then to continue to raise rates. But you've got to understand what's going on globally with bonds, huge amount of unrealized losses, people taking money out of the banks. There's a lot more to it than just inflation, right? So this is where the Federal Reserve is. It's stuck between a rock and a hard place. Does it reduce rates or pause rates and thereby see inflation move higher, or does it crash the whole global financial system? That's pretty much where it's at. So my best educated guess, again, no one knows, is to see the Federal Reserve pause as a minimum rates rising for now because of the situation that I just explained with the bonds and the huge unrealized losses and everything else. So that's what I'm seeing right now. Now, as far as potential ideas that we're looking at, I mean, the other thing to keep an eye on is the fact that to make note of, should I say, is the actual markets are closed on Friday for Good Friday, right? So it's a short week this week. We just finished the first quarter, the first 3 months of the year. There was a lot of window dressing, which simply means that we tend to see stocks move up into the last part of any quarter so that their books look good, they actually look better than what they really are. That's typically what happens there. So we may see a little bit more of a move up, but it wouldn't surprise me to see a little bit of a pullback, not straight away, but leading into the next couple of months, unless, of course, the Federal Reserve changes their stance on raising rates. So that's where we're at right now. We need to keep a close eye on things. Now, as far as potential ideas that we're looking at, we are looking right now at tractor supply to the upside. Okay, it's been consolidating for quite some time. I'm looking for this to move higher. I only needed to get above 250 for me to make a very substantial return. I can make a 3-to-1 risk to reward. In other words, my potential upside is 3 times higher than the risk I'm taking to achieve that profit, to achieve that upside. So we've got a very interesting trade there. And also McDonald's as well, been moving up very strongly. If you look at it from a weekly perspective, really starting to break out here. McDonald's actually has a daily, weekly, and monthly squeeze. Sean, what's a squeeze? It's where a stock is becoming squeezed because it's becoming very, very quiet. It's consolidating. It's building energy. It's building buying pressure in this case. It can be selling pressure, but in this case, buying pressure. And it's looking to release that energy to the upside. That's what I'm looking for here. So we have a daily, weekly, and a monthly squeeze on McDonald's. I'm looking for an upside position here. I'm looking for McDonald's to get above 290. So that's what I'm looking at there. A couple of positions that we're looking at right now, but as far as what's going on globally, that will give you an idea, right? You go over this video again, you start to paint the picture of where the Federal Reserve is, what they're likely to do. Because remember, the market's controlled by what the Federal Reserve is doing. The market is controlled by the Fed right now, no doubt about it. So we have to be able to start anticipating what they're likely to do moving forward, and we could see an explosive move in risk assets if the Fed does pivot. So we'll keep an eye on that. We don't know what's going to happen, but in the meantime, I'm looking at Tractor Supply and McDonald's to the upside short term to make some income. When you are looking at things like this and you understand where we are with the financial system, you don't sit on the sidelines and wait for something to happen because no one knows what's going to happen. You take short term income positions where the potential reward is much higher than the risk, and that's how you prosper, right? And you only have a fixed limited risk, right? So we're not taking huge amounts of risk, but the potential upside is significant while we wait and see what the Federal Reserve is going to do. All right, my friends, hope you found something useful from that. I'll talk to you again next week. All the best, and bye for now.